All right. I think I am all set to go. How you doing, friends? Yeah. I don't know. Do you like that music? If you like it, it'll continue. If you don't, give me a suggestion on new music. I like it. It came with the system and good intro music. Nice and upbeat, lively, old school. I like old school, and that's kind of like what we're going to talk about today is old school. And as the thumbnail implies, it's all about the risk to return. And more specifically, it is all about the highly skewed asymmetric nature of risk to return and how that is what you're really looking for in a strategy, in a system, if you want a positive expectancy. And that's the really important part, a positive expectancy. Because most strategies, if you didn't know this, do not necessarily have a positive expectancy, even if they do have purportedly very, very high win rates. When you see a strategy where they claim that they have 90, 95% win rate, and then they tell you that they manage all the risk all the other times, you have to be skeptical. Now, it could very well be that the person that is running that service does have that kind of win rate. However, that does not mean that it is a winning strategy, or the wins are so small that you'll never really make any real progress. And so that's usually, I mean, that's the trade-off that you make. The other thing is that a win rate is a very high win rate. And if you expect that you're going to also make a lot of money from that through a high win rate, that implies that you're going to have to use a lot of money. You're going to have to put up a lot of cash because each one of those wins are going to be very, very tiny. And it's going to require you to put multiple contracts on. And because of that, there is a number of things, a number of caveats to that. But the first is, and the biggest, is the risk. There is always huge risk associated with high probability strategies. Always. You cannot get away from it. The other big problem is that means that you're going to have to put up or use a lot of margin. A lot of margin. And if you want to have any kind of appreciable return, something that will stick and that you can have an account that will actually grow and maybe do something better than inflation, then you're going to have to put on a lot of contracts. And if putting on a lot of contracts and a lot of positions, what that really means is high commissions, huge high commissions, and very inefficient use of your money. That is the caveat to high probability strategies. There's no getting around it. Now, a lot of people will claim that they can manage those risks and take away a lot of the anxiety associated with that. But I can't tell you how many. Look, I've been around the block a few times. I've worked with thousands and thousands of traders. I myself have been and analyzed and written literally thousands of strategies. I tried all the high probability stuff. And at best, they're a coin flip at best. The management, what you don't really understand is that even though it has this high win rate, puts you immediately on the defensive and in a negative situation where you have to start worrying about the risk and managing that risk. So you're spending all your time in this kind of negative world. That's what it is. And and then hoping that it's going to stay there and that it doesn't move too far. I mean, even if you put it way, way out of the money, as soon as it starts going towards the wrong way, even if it has a long ways to go, it's going down in value. Your account is going down in value. And you're saying, well, how much of this can I take? How much can I take? And can I be sure that it's going to not get so close that I cannot withstand that drawdown? And that's what happens. Now, a lot of traders will say, well, then we simply just put a stop on an options play. We put a stop, and that will cap your losses and also kick you out of the trade, even if, and many times that trade may come back and be profitable, but at that time, as soon as you hit that stop, you're out of the trade. You're done. You're managing to lose, all for that tiny, tiny little profit. And when I say tiny, I'm talking 3, 5, maybe 10%. Traders in this kind of realm, if they make 15, 20, or 30%, they think that the world has bestowed them the most unbelievable gift. It was such a huge winning trade. And those happen very rarely, but they can happen. And here now, okay, so now I'm going to tell you about the flip side. The flip side is that, and the other problem with all of this is that the reason why they put on these really high probability strategies is because they're facing a reality. And the reality is that they cannot really tell where the market's going to go. They have no idea. They have no idea how it's going to behave. Today was a perfect example of something like that. We had these 2 huge psycho up days, and then followed by today, it looked like it was going to be another psycho up day. Then it just reverses, and then it just stops. And then instead of a big range, it squeezes the range into a tiny, tiny little space. And something like that is just so difficult to really understand. How am I supposed to tell what it's going to do from day to day? There are so many factors that are coming into the market, some of which you can keep a handle on, most which you just cannot. The market is very difficult. And I've been recently reading a lot from a famous mathematician, Benoit Mandelbrot, or Mandelbrot. And what he talks about there makes a lot of sense, and what the market is really about, that it is unknowable. It is, in effect, a chaotic situation. However, there are things that you can do if you believe and if you understand that that's what the market is, that it is virtually impossible to tell where things are going day to day. Now, you can fool yourself into believing that you can do it for a while, and there are definitely techniques that you can use to at least get you in the ballpark, but ultimately you don't know what's going to happen. So there are 2 ways that you can play that. You can play it with a super high probability strategy, quote, high probability, that comes with all kinds of risk and anxiety and angst, and then constantly being on the defensive. Or, am I getting a noise in here? Or you can take a completely different tact at it. You can say that I don't want to take the risk. I don't want to basically leverage my house so that I can make pennies. Or what is the saying? I don't want to pick up pennies in front of the steamroller, because that's essentially what you're doing. Instead, you take a smarter approach, a more cost-efficient approach, and recognize that you don't know where the market's going to be, but you could set your trades up in such a way where you put a tiny little bit of risk. And if, in fact, the market hits your return, hits your target, you can make a huge return. And the benefit of something like that is that you're not using hardly any capital, and you're not doing any kind of risk management. The risk management is the bet itself. So, for instance, like this is an extreme example. If you buy a lottery ticket, are you doing any risk management when you buy your $5 or $10 ticket, hoping that you're going to win thousands or even millions of dollars? Of course you don't. There's no risk management. It's all upside. Now, that's an extreme example. However, you can bring that down to more realistic things and think that, well, where my normal position in a strategy might be several $1,000s so that I can try to make a couple of $100. Uh, Now I'm, instead of putting all of that risk out there, I'll put on maybe $100 to see if that I can make 1,000 or a couple $1,000s. Now, that's a completely different situation, considering that if you have a loss on the high probability side, it could literally wipe out weeks, days, weeks, months of your profits, regardless of what type of risk management that you say that you're doing. Because we all know that we're humans, and even though we're putting on trades like that with some risk management, if you take a few losses in a row, you're going to take some chances, and you're going to feel the wrath of what it is to actually trade a high probability strategy. Happens to everybody, and that's how virtually everybody that day trades and trades this sort of thing eventually succumbs. Eventually, it happens to every. It's happened to me. It will happen to you, and it won't just happen once. It will happen several times. There are a few people that might get lucky and pass through the gauntlet. Very, very few. So the other or converse of the high probability strategy is a high probability outcome strategy. And the reason why there's a high probability outcome is that when you're playing extreme asymmetry, when you're making your risk very small to large return, there's a much higher likelihood in the long run that you're going to see a positive expectancy with that type of strategy than the other way around. In fact, the high probability strategy often has a negative expectancy, and the only way that you can turn it positive is through extreme measures. So I don't want to take extreme measures. I don't want to feel all that anxiety all the time. I don't want to put up, huge amounts of money for tiny little gains and then feel like I'm under pressure every single time I enter the ring, the trading ring. I just don't want that. So that's why we trade the way that we do. And if you look at that methodology, this is not a new thing. This is actually a pattern that is used by the most successful people in the world in virtually all professions and all areas of skill or chance or investment, where they take small risks for huge outsized gains. You go and ask any self-made millionaire or even billionaire, man, you just seem like lucky as hell. Everything you touch, you have the Midas touch diamond hands and everything turns to gold. And they'll tell you and they'll correct you. No, I've lost a ton of times, but every time I lose small. I make small, smart, intelligent bets, and I put it out there. This is how a venture capitalist works. They spread their bets all over the place, tiny, tiny little bets. And a good portion of them will come in and basically cover their cost. And every once in a while, they get that big one that makes life-changing returns. Virtually every professional trader that I've ever met trades this way. Virtually every venture capitalist I've ever seen, any successful business person I've seen does the same thing. They take small bets. You even go down to looking at, I don't know. Let's take off the top of my head, Edison. There's a good example. Inventor of the light bulb and many other things. It took him 10,000 tries before he made the light bulb. And those tries didn't really cost him anything, but what came out of that was human changing. It changed the entire world. So that is really the formula. That is the formula for success in the long run. It is also sustainable. And anybody can do it. Anybody can get into a low what is essentially a lower probability strategy that has positive outcome and stick with it. Now, there's other benefits, probably the biggest benefit of all, and that is the one thing that plagues people in most trading strategies, and that is the mental aspect of trading. And the mental aspect of trading comes from that anxiety that you get from putting all that money on the line and hoping that it's going to go your way. If you didn't have to deal with that, if that wasn't an issue, if that never came to be, and you didn't feel that angst, that that shaky feeling that causes you to panic and make poor decisions, then you would, on the converse, be much more controlled, sedate, focused, clear-headed, able to make clear, logical, rational decisions, and therefore better decisions. So you have less risk, less pressure on you, you make better decisions. On top of that, you have a system that actually has a positive outcome from a statistical point of view. And you're just not feeling that angst anymore. The anxiety is gone. It's just 1,000 times better. And when you put this type of strategy through like an expectancy calculator, you can go online and take a look at any expectancy calculator out there for options or whatever, and plug in the typical criteria for this strategy compared to any high probability strategy. You'll find that our expectancy is far higher and the actual money that you make is much greater. And if you were to compare dollar for dollar in terms of risk to return, you would find that trading this way is up to 25 to 30 times more efficient. 20 to 30 times. How can you ignore that? Really, how can you ignore that? 20 to 30 times more efficient. It's incredible. Let's go to the roll call. Let's see who's online right now. We don't have too many people right here. I'm sure they're all sitting in the background. We have Mortimer Duke. How you doing? Nice to see you. Iz likes the music. Good. I'm glad to hear that. Dan, you weren't first this time, so I don't know what's going on there. Riza, how you doing? New member. GK, good to see you. Jim S. And Tim Dodds. I'm sure there are others still come flowing in. Today was one of those days too. You know, if you looked at the past couple of days, even if you were playing one of these high probability strategies, these past couple of days may have eluded you. And I know that if you were in some of these high probability strategies, it absolutely would have eluded you. Now, that's not to say that, that it didn't elude us. It's the effect that is different, right? So from our point of view, if it did elude us and we weren't able to capture that profit, we had very little consequence because of it. It was just another day. It would be like, okay, you can, when you fail, you fall off a cliff. When we fail, we take a step down, on a stairway. So our loss, if it was a loss, is very small compared to what these other guys are doing. And actually, in most cases, because we're putting things out there, even with ours, we have a very good chance of profiting anyways. Those type of trades, we actually do profit more often than not. But even if we were to miss out, the consequence is very small. But that's what it was definitely like these last few days, where, we're in this kind of bear market rally. And bear market rallies, if you talk to any trader, are one of the most difficult environments to trade because, first of all, there is this cognitive dissonance that you have between what you believe the market is doing. You believe that the market is, a cesspool right now and that it should be going down. But then there's something that happens or some psychological market reason why it has to kind of reverse. And it does and you were all sitting there trying to figure out what the reason is. And sometimes you can identify things that you think are the reasons, and I talked about that earlier this week when I talked about the rumor mill that happened over the weekend and the cause of these psycho rallies that we had. That's what I call them, these psycho moves up, because they seem to come out of nowhere, and they're usually for some unsubstantiated rumor or idea or narrative that the main players in the market make up in their head. I mean, we're currently living in something that I would call opposite world, and I'm sure you've heard people talk about this concept, but or if you've watched some YouTubes and other analysts, they're all talking about this, and this is something that we know very well here, and it's an important part of our analysis to really understand the Federal Reserve and how the rest of the world is kowtowed towards the Federal Reserve and what they are expecting. I mean, most big traders, investors are more interested in what is the cost of money so that they can fairly value their investments into the future. And so virtually everything that they're doing is based on that. I'm getting this weird, no, I can't answer this. Someone is calling me. I'll have to turn this on. Someone's calling me through Instagram. Sorry, can't take the call right now. Not Instagram, through Telegram. Let's see. We have some more members here. We have Hans, how you doing, man? And Alan Sturba. Rick Ritter, how you doing? Haven't seen you for a while. Rob Fresno. A new trial member, nice. Riser wants to know, is the video buffering for anyone else? It is choppy, really. There might be something going on. I mean, I noticed last night that there was a little lag in the internet, which is unusual because I'm not on wire or anything. I'm wired directly into the internet, and I have one of the fastest internet you can get up here, as fast as it can be. So it must be somewhere else. Yeah, so they're universally seeing that. I wonder if the wife is streaming multiple videos again. Huh. Interesting, because I didn't see it on my end. I did see something earlier today, which is unusual. Usually don't. All right. So what I was getting at was the narrative, and there's this thing that we call opposite world with the Federal Reserve, this debt-based model. The fact that we have to borrow for the money that we use. It's just an insane way. And then the idea is then that you can control supply and demand through the control of the supply of money. And the problem is that the market as a whole, in the same way that that nature is something that was developed has huge complexity and was developed over a long period of time, and it's this sort of natural organism. The market in many ways is like that just because of the complexity and the number of people and ideas and everything that are associated with it. It has its own life, its own brilliance, I guess you could say. And whether you think so or not, and the idea that we can control something that complex, that any central organization can actually control, that is, I think it's like the height of arrogance. It's just incredible, as if we can control the weather or our environment around us. I mean, there are limitations, and we can control some things, but we can't predict it. That's for sure. We can't try to control human behavior, for instance. It always results in disaster, or eventually results in some form of tyranny and then revolt. Why? Everyone's calling me now. So it's the same way with the Fed. They're trying to control this beast that is incredibly complex, and they're always too late or too soon, too much, too little. They're never there, and their mistakes cause and have huge ramifications. Yet they believe that they still have control, but or that they can affect things. They think that they have the tools, but they don't know how to use them. They have, something 3, 4, 500 PhD level economists that cannot get it right ever. Just think about that. They have never gotten anything right. And they are, in fact, the people and the organization that actually puts us into a recession. Now, do they get us out? I don't know. That's a hard one to say. But we're constantly led by what they're doing because they do control the cost of money. And the cost of money will determine how we value things into the future. And so when they devalue things, and now they believe they have to devalue things because of all of the inflation that they have instilled into our economy over the past decade and a half, 2 decades. When they devalue things, they're not cognizant of all the different machinations and things that affects, the run-on effects. And it was basically, I'm talking about risk to reward earlier, and I'm saying that, we choose these strategies because we cannot predict what the market's doing. So we choose strategies in such a way that have little impact on us, but we're essentially setting landmines around and hoping that the market steps on them. And when they do, it works out well for us. But we can't tell where the landmine should go, or maybe we can come up with this very intelligent and sophisticated pattern or something, but even that rarely works. So to think that the Fed can get out there and actually make these changes with just a couple of levers, and that they can somehow do that for the benefit of this huge, vast, and complex system is really, I think, is the height of arrogance. So that's where we're at. And so what we need to do when the Fed is doing something, they're making a decision or they change a policy or a stance on something, we need to understand exactly what that means in terms of the future cost of money. And so that has set up a rather interesting dynamic right now that we call opposite world. And so what that means is that anytime the market, what we would think would be a good thing happening to the market, like a good economic report, like let's say that employment all of a sudden exploded and something like that, or manufacturing had a big uptick or bigger than expected, that right now is viewed upon as negative. And the reason for it is that because the Fed has got us into this high inflationary environment, anything good would increase that inflationary environment. Now that's bad, but that's not the reason why an investor would think that it's bad. The reason why an investor would think it is bad is that would mean that the Fed would have to continue and maybe increase their interest rate hikes. And that's what's bad from the investor's point of view, because it would increase the cost of money down the road. And so if the economy is getting better, they think that the Fed has got to do this. If the economy is getting worse, then that's good for the market. The market will go up. Why? Because then the market has this notion that maybe the Fed now sees the effects of what they're doing, maybe, or they think that they're doing, and perhaps they'll back off on their interest rate hikes and maybe even get to a pivot where they go the other way around and start instituting a more accommodative monetary policy that they call QE, quantitative easing, right? And money managers and fund managers and investors, they love that. Cheap money. Problem is that starts causing inflation again. So you got this problem. And normally when we have high inflation, we don't have problems with the economy. Things aren't so bad. But right now we have that kind of double whammy where we have a receding economy and high inflation, basically because of the the zealousness of the Fed and continuing this accommodative monetary policy even into times when it was unjustified, and creating this huge pile of money, an oversupply of money that obviously, if you take economics 101, more dollars chasing the same goods increases inflation, and that's exactly what's happened. And they did it until economic conditions started to deteriorate, and they kept on deteriorating, yet they kept on moving forward. And so now we have a condition called stagflation. And so now they don't know what to do. Actually, their solution to stagflation now is to basically tear down the economy, do the exact opposite of what the Fed was mandated to do, and that is to create maximum employment and a stable economy. And what they want to do, because the only way they can fix this is to create a deflationary environment, and that is to break the economy, do whatever they can do to spur job loss, because fewer people out there working have less money to buy goods, and in theory that would cause deflation and knock down the economy, which would also cause companies to go and fire people. So that's their answer, is to do everything that they're mandated not to do. So that's where we're at. All right. All right, so Swapnil, how you doing, man? It says, good afternoon. I thought it was my Xfinity, but yeah, getting issues with buffering. It's still happening, huh? Mercury retrograde ended October 2nd. I wish I knew what that meant. JD says, so I think I'm exactly the guy you talk about, Ernie. I typically sell a 16 delta call or put spread mid-afternoon and run about a 82% win rate, but I typically stop at 3x or 3 times the credit that you collect, right? And today I rolled the dice and sold SPX, a 5 wide spread at the money to try for a faster decay. Unfortunately, I'm anxiously managing my losses at the moment. And that's it. That is it. That's exactly what, that's the life of a high probability trader. Dr. Russell, how you doing? I like the 37.55 10 wide around 312, but I couldn't get my price. That's a good thing. I'm glad you recognize that and just stood aside. I wonder if there is still a good trade out there for the final hour. Riza, can we look at a possible last hour trade? Yeah, we can. But not now. It's 5 minutes of. I mean, do you really think that there's an opportunity here? The market seems to be creating what I would call a doji and settling right in on this what would be termed a balance. Today's session, today's market profile has turned into this very well-defined balance. Almost looks like a normal distribution. And when that happens, I don't know where you put there's no room to actually put a trade. It's not moving very much. It moved a lot in the beginning and then just petered out and just did this. So I don't know how you put a trade on something like that. So it would, it's nice to think that you could put something on in the last hour, but there was no opportunity here. So let me see if I can go to the charts and just explain that and show that. So, I had a trade on very early. There was a pattern that happened very early in the day, what I call a a curve, and it broke through resistance here, this line here, which is actually an LVN, and then started to move up. When it moved up, it looked like, and then stopped here and moved up again. Right here looked like a good opportunity, and that's what we were going to do, go higher. And this right here was the scenario that I had plotted out for today, this arrow, this yellow arrow, and this was the alternative scenario. So two scenarios. Now it looks like the lower one was the favored, but early in the morning it looked like this. Now this reversal here is typical of bear market rallies. When you're in these bear market rallies, you get these reversals, and they thwart everything that you think that you're doing correctly. Now, if this was yesterday or the day before, both of those days had these same patterns, and they both went up for nice long days. But today, for some unknown reason, and maybe there was some news out there or whatever, it just decided to reverse. Right. So one of the bad pieces of information that caused it to initially go up was the employment report. And remember, I talked about opposite world. The unemployment report was particularly bad, much worse than expected. And this may be just the beginning of what I think the market may be experiencing from the Fed's need to try to wreck the economy. And they can do it whether they try or not. So I don't think it makes much difference. But when that came out, when that unemployment report came out, that was bad news. But the market went up in response to it, because now the market feels that the Fed is going to maybe resort to a more accommodative money policy, employing what a lot of people are calling the pivot. Now, yesterday, a lot of people, or very early this morning, people thought the pivot was done because of some things that people said, like I think it was Neil Kashkari that came out and said that there's just no way that the Fed is going to pivot. As a matter of fact, that's exactly why it reversed like this. So the initial move up was because of bad news, all right, opposite world. And then they're all thinking, oh, it's getting really bad. The Fed must pivot. They can't continue this policy and just put everybody out of work. But they've promised that they're going to do it anyways. But the market doesn't believe that yet. And then right at this point, Neil Kashkari, a Fed governor, comes out and says, no, we are definitely not pivoting. We've got a long ways to go. And so that knocked the market down. And still, the market doesn't really believe it. So now they're in this quandary. Man, do we believe what they're actually saying, or do we believe what they need to do? So that's where we're at. And in that environment, really, I'm just wondering, how do you trade that? So look at it this way too. We're talking about risk to reward. If I cannot put on an asymmetric trade here, then why would I put on a trade? In other words, if I don't expect any kind of expected move, if the expected move has dwindled to virtually nothing, there's no expectation for profit. So how can I put on a trade? Right? Now, I know that you want to trade. Everybody wants to trade. Everybody wants action. But you're only going to have action and positive action and potentially positive return if you have some kind of signal or some kind of something that will rise above the noise. But right now, the market is in this sort of sideways pattern of noise, because it doesn't know whether or not bad news is good or Kashkari's signal is bad. They just don't know. And so they're going sideways. And this little dip here to, right at the last hour is very minor. I mean, that's not a very big move at all. And now we're moving back towards this, what it looks like the session POC, which is right here. And so this is a very, very tight session node, and what we would call a nice balance, or a balance. and where everything is very well contained. We don't have a distribution of different nodes. Everything's very, very tight. So that's not conducive to putting on a trade. It might be for the high probability guys. They could then put a nice big iron condor around this, but they'd have to be aware because at any time that could jump out of there. They could put a nice big iron condor around this and maybe feel a little bit more comfortable because the market it really isn't moving that much that they could capture price within their condor. But for most days, that's just not possible. And today, that's not going to work for us for certain. Um, yeah, sorry about that. Yeah, Rise. There is tomorrow. Um, I'm almost to the point where, especially during these bear market rallies, to look for reasons not to trade as opposed to reasons to trade. I feel like that's a better use of my money. And that could change. That could change soon. But right now, it is just it's unknowable. I mean, things have to crack. That's what I want to see. I want to see a crack, a big, wide crack, something to open up. Good or bad, it doesn't matter to me, as long as we get some movement. And right now, the movement is unnatural. It's really born out of panic and this, just no real direction, chaotic, Brownian. I don't know. Is that Brownian motion? No, it's not even that. It is. There's a lot of static like Brownian motion, and then we're trying to find the signal inside of that static, and it's just not rising above it. Or when it does, it immediately then disappears again. Ah, so Alan says that Fed Governor Lisa Cook was also hawkish today. So the other thing is that we had Lisa Cook on, and we didn't have her on our program, but she was one of the talkers today from the Fed. And I know that there are two others that are coming out after the market closes. So that's three Fed governors that are talking today. So I would imagine that they're going to, I don't know, I would think that what their main goal right now is to try to convey that they have a consistent message and that everybody on the Fed is sort of lockstep in what they plan on doing. Because until that happens, you're going to have this opposite world problem where investors are looking at various things that happen in the market, whether they're negative or positive, and then make their assumptions on what the Fed might do. So that's why now you're going to see the Fed come out more and more every day. As a matter of fact, this past week was just unbelievable how many appearances that we got from Fed governors. It's really remarkable. You hardly ever see that. And well, and part of that is because we're not going to see the next meeting where they're going to discuss rate hikes for, let's see, almost a month, just about a month. November 3rd, I believe it is. So that's a lot of time. And in particular, with the election, pre-election craziness that's going on between now and then, that can cause a lot of volatility in the markets. I think you're going to see the Fed and the Fed governors out there on a consistent and constant basis to try to reassure that what they're doing is steadfast, that this is the way things are going. It's not going to change. If you didn't have that, I think that the markets would just basically their heads would explode, kind of like that movie Scanners, right? Did you ever see that movie Scanners? Now, that's a crazy movie. It's where they get inside your head and they can make it explode. That's kind of like what the market's going to be like if they don't have that reassurance of direction. And so I think generally the market doesn't really care if it goes up or down. They do to an extent because they can make money either way. It's when they don't know. And of course they would rather go up, no doubt about it. But if they at least knew what to expect, then that makes things a lot easier. Here they don't, and so they're just stabbing in the dark. So that's where we're at. Well, it's 346. Can we take a trade? This is what I would think. Let's first of all, if we took a trade, it would have to be super low risk, right? So that means also a narrow trade. And a narrow trade might work today because of the limited range of motion today. So if we were to add the SPX onto here, so we can get the difference in price. Let's take out all of this other stuff. It's getting in the way. So there's the SPX, that blue line. All right, and so the difference in price right now is about 12 to 13 points. So that's about 2 strikes. We have a session POC right here at 3768. Let's call it 3768. So if we were on the SPX, we'd have to subtract 12 points from that. Let's just call it 3750. All right. So yeah, so what we're saying then is that POC, we're looking at that, right? It's only 3768, only 8 points away from price. So that POC is right there. Now we're falling. This might actually present an opportunity because I think the fall will set us up for a move back to the POC, unless the market is just falling. Maybe the Neil Cash carry stuff is definitely holding on and sticking to the ears of traders. And you look at this, it went down, rebounded a little bit, and then lower highs, lower lows, all the way down, even to here. And now this tiny little dead cat bounce, and then coming down again. Maybe the move is now. What do you think? What do you guys think? I mean, what do you think that it's more likely, given the events of the day and this motion, that we make a new low at the close, or do we go towards the relative comfort of the value node, the session POC? See, I don't know. I think that it's just totally up in the air. So if you're willing to throw away, I don't know, $20 for the potential to make about $200, then I guess it's okay. Let's see. Matt says he sold a butterfly SPX 100 at 37.75, 37.35. Well, that's way down. So he's betting, Matt's betting that it's going to hit a low today in 10 minutes. I think it's probably equally possible that we come right up to the session POC. But the low is going to cost less because it's further away. All right, so that's at he picked 37.35. Oh, so that's what you got out at, or are you just going short? You better hope that it doesn't go down there if that's your opening trade, Matt. Right? Is that your opening trade? That would, that would be risky. Adam says a move downward to close the session looks likely. Yeah. So if we went to a 37.35, let's analyze SPX. It's pretty close. A lot of volume out there. See, we could go 5 wide. So for $40, if you could get this for under, if you get it for $40, let's see if I can get it for $40. That was for 50. I want 40. Whoop, that was 35. Well, what the hell? Let's go for 35. I don't know that we're going to get it for 40 though. 35. Let's try bringing it up to 40. Cancel and replace. So I'm going 5 wide. I'm going super super cheap. I don't know if I'm going to get it though. And we'll put it into, there it is. Ah, filled. What did I fill it for? 40. All right, we're in the game. That's because we had this little up candle. And we only have less than 5 minutes to go. Yeah, and I just threw away $40, I bet. See, this is why I didn't want to do it. Now watch, it's probably going to take off from here. It's one of the bigger candles. Oh, I see, Matt. Nice. You got a in at 250, out at 635. Fantastic. I don't think my $40 trade's going to make anything. Let's see if we go down to the session lows. So isn't that something? As soon as I put the trade on, it decides out of this little downturn that it's going to go up. So Jim's got 37.65 for 5 wide. So he's taking the other side. Oh, here it comes. Might just do it. See, I have a losing trade on. Let's see if this one is just regroup it. You get them all? All right. It's up here. No, it's down $17. It's not, it hasn't fully broken down yet. See, it's right there. We just needed to go down about 5 more points. A little bit more. Come on. Make a new low. It's only got a few seconds to go. And it just jumped up out of range. Ah. Yeah, but it didn't do it. It's got to go down now. It's got to make a new low in order for this to profit, but it's not going to do it because there's no time left. Oh well, just threw another $40 away. See you. Yeah, it was close. So who pushed me into that? Who pushed me into that? Would that? Um, nah, no one pushed me into it. I'm just looking for someone to blame, but myself. That was worth a try. I mean, it came down here, and it just needed to go. And if it had broken a low, it would have definitely gone in there, but it just didn't want to. Yeah, big sell volume at the close. Yeah, it was so close, so close. Yeah. You shouldn't have washed your hands. That was the problem. That was the problem. All right. Well, that was fun. Yeah, it's always fun to throw $40 down the drain. What the hell? Let's see. That can't. I can't. I don't know. Let's go back to the big head here. I have to admit that the final hour trades are definitely fun. Trying to guess that within a very precise area, where price might go, and the payoffs can be fantastic. I mean, if it had hit and if it pinned, you could make over $400. So for a $40 trade at 10x, that would have been nice. Oh, you thought it was a clap emoji. It was a wash your hands emoji. That's funny. That is really funny. So, yep. So hopefully you like my little talk about risk to reward and why it's so important that you look at it from the two different sides. There for a lot of people coming into trading or people that have been trading for a long time, they've been indoctrinated into this idea of high probability strategies. That is like the holy grail. If it's the holy grail, but nobody actually, you're not getting wide ranges of people making money from it, then how is it the holy grail? It just isn't. When the professionals are taking this asymmetric position, more often than not all of them, but more often than not, that's what they're doing, and they're doing well with it. Wouldn't you think that would be the way to go? But that's a world I think that most retail traders are not involved with, so they don't know. Anyways, if you just look at the prospects of what I just did there, if I were a a high probability trader and I was going after $400 of profit like I was doing there, I would have had to put up about $4,000, all right, for that $400. But here I put up $40. Now there was probably a good, I would say, I'm going to say probably a 25-30% chance that it would have worked, right? And if it had gone anywhere close to there, I could have made some fraction of the $400. And for a $40 bet, that I think that's the kind of bet that you can make a lot of, right? But how many bets can you make with the $4,000 to make that 400? You only have to lose once, and in a market like this, losing would be a relatively high probability. And yeah, I just can't see doing it. Besides that, even if it did end up within the zone, and you had that $4,000 bet on, it might move far enough away to make you so nervous that you would have to get out, and you could quickly go to a $1 or a $2 or $3,000 loss, and it could have eventually won too. But the in between that huge loss or unrealized loss could be such a weight on you, and you don't want to go to the max loss. I mean, even if it was like $1,000 loss, that would be just really hard to do. More often than not, you would probably exit that trade, and then the odds are that it would come back and you would make the $400 anyways, or you would have. So, oh, Matt says, "Don't tell the wife." Yeah, I don't think she's going to fret over $40, but yeah. So you got to look at these things in perspective. That I probably had a better chance of making the $400 than a high probability trader would have at having an unrealized loss of $1,000 or $2,000 to go after that same $400. Yeah. So there you go. All right, that's about it. And I know that now I need to get going because I've got business to attend to. I want to thank you very much for coming by. Peace to you all, and we'll see you tomorrow. Take care. And more music.